Welcome back to the Yahoo Finance All Market Summit presented by Northern Trust. Stocks and bonds are in bear market territory as the world faces macroeconomic headwinds driven by rising inflation, geopolitical tensions, and an energy crisis. Here to talk about what this means for investors and more, let's bring in Northern Trust Wealth Management Chief Investment Officer, Katie Nixon. Katie, it's great to see you. Certainly has been a troublesome time here in the market since the start of the year. S&P coming off its fourth down week in the past 5 trading weeks. We just got another hot inflation print for the month of September. Help us make sense of where things stand today.
Well, Seana, first of all, thank you for having me today. It's a pleasure to be here in the studio with you.
Finally.
So great to be here. And yes, it's been a really tough time for investors. But I think a little perspective is helpful during times like this. And, as you noted, we're in a bear market, doubtless. But we've been here before. And if you look back in history, over the last 100 years, we've had 26 bear markets. We've had 14 since World War II. We've had 3 since the year 2000. So in some ways, this is uncomfortable but familiar territory. And we know bear markets end. The average bear market lasts about a year. We entered into this bear market in June, so perhaps we're hitting the mid mark of the average. The backdrop certainly matters, and more severe bear markets tend to take place with more systematic risks or deep recessions. We don't see either of those things, so I do think that kind of history is important. And it also is important to look at returns. And as you noted, of course, we've had a very tough time for equities. Equities fall anywhere between sort of 20 and 40% in bear markets. We're just over 20% today. But we also know that during bear markets, there tends to be a lot of volatility and there tends to be a lot of up days. I mean, today's a good example. We had a couple of examples last week where we have these, incredible rallies in the middle of a bear market. So I do think investors should have some historical perspective and then perhaps take a deep breath, because although it's really tempting to try to time investing over a bear market cycle, gosh, when you see those numbers ripping up and down, you feel like you should do something. Unfortunately, the best but most uncomfortable thing to do is to do nothing, because we have these great days in the market that are quickly followed by some tough days, and they all happen in the middle of a bear market. And Seana, I was thinking this morning, over half of the best days of the market happen in a bear market. So again, I think it highlights the perils of trying to time markets and the risk that you're going to be out of the market on those best days and the real damage that can do to your return over even a 10-year period.
It certainly is important not to time the market here. Before we get more into that, though, Katie, when you take a look at current valuations, S&P, like you mentioned, off more than 20% year to date, NASDAQ down more than 30% year to date. You mentioned the fact that you don't see a deep recession on the horizon. Do you think, though, we are at risk of a recession, and what does that potentially look like?
Certainly, Seana. I mean, I think absolutely we can anticipate a period of economic softness here. And I do think the definition of a recession sort of ebbs and flows. But let's just say, for the record, a period of economic softening is what we anticipate for 2023. But I think you mentioned valuation, and that's really, really important, because if you think about this particular bear market, it kind of is in 2 phases. The first phase is very much a valuation-driven experience. And interestingly, you even mentioned like the NASDAQ and then the S&P. The NASDAQ is the growthiest index. The S&P is also a pretty growthy index, and they're very sensitive to changes in interest rates. We know the market is a discounting mechanism, and when you have a higher discount rate, you have a lower present value. So the growthiest, NASDAQ, was hit the hardest. The S&P has been hit pretty hard too, and valuation contraction has been more than 100% of the market downturn this year. Earnings have been up. So all of what we've seen this year has been a contraction in valuations. That's phase 1. The second phase is related to your question about a recession, and that is what's going to happen to the E of the price to earnings, the earnings. And we think earnings are probably going to be soft in 2023. We have an estimate far below what Wall Street analysts have right now. We think they're just a little bit too optimistic on the go-forward view, given the fact that we are entering a soft period.
And Katie, what is your estimate on earnings, and why do you think Wall Street is a little bit too optimistic at this point?
So, I mean, we've seen corporations, U.S. large corporations, be incredibly resilient in the face of an incredible amount of headwinds. We've had higher rates, we've had pandemics, we've had problems in getting workers back to work. Despite that fact, we have had pretty good earnings, and I think everyone was sort of waiting with bated breath for the shoe to drop in the second quarter, and it didn't. We had a good second quarter. Estimates have come down to the third quarter, but the third quarter might shape up to be pretty decent too. So I think Wall Street analysts are just building off those kinds of estimates. But for us, with a softer growth outlook in 2023 and the fact that the S&P 500 has about 40% of their revenues tied to overseas growth, we just think those headwinds are pretty strong, and we come in sort of around $228 for S&P earnings for next year.
And you mentioned that statistic there, 40% of revenue coming from overseas. That, of course, brings up the strong dollar, the risk of the challenge that poses for companies here. How are you assessing that risk? And I guess how long do you see that risk lasting here? Because it doesn't seem like anything is going to take some of that strength out of the dollar anytime soon.
Well, you're right to bring up the dollar. As they say, our currency, your problem. And it has been a significant problem for U.S. corporations overseas, and also for the translation of non-U.S. investments back to U.S. dollar terms for our investors and for our clients. Developed markets, ex-U.S., have outperformed the U.S. on local currency terms, but when you translate it back to the dollar, it's been a huge headwind. So what could stop the dollar? Well, what propelled the dollar has been a very aggressive Fed coming out first and very aggressively with this rate hike path that has been extremely front-end loaded to face inflationary pressures. We think we're closer to the end of the policy tightening. We'll probably see the last rate hike in early 2023. And we also see inflation coming off the boil. Those two things should help to stabilize the dollar. So we don't anticipate we're going to see the kind of strength that has created these headwinds in 2023.
You mentioned inflation coming off the boil. To put it in your terms, do you think we have seen inflation peak?
So inflation has so many dimensions, and many of them, particularly the ones that were really pressured because of COVID, have been abating. Supply chain constraints have come off. We see prices coming down in used cars. I mean, we're all talking about used cars these days. It's a pretty important price barometer. So we see inventories up, prices down, and some of the things that have been really impacted by COVID. So generally speaking, we do see inflation coming down. We saw an Empire State Manufacturing survey this morning that had some interesting insight on prices coming down. Where we are still concerned, though, is in wages. And also, frankly, in owner's equivalent rent. These two pieces of inflation are sticky. Owner's equivalent rent, we can all see that prices have stabilized and have come down, but it takes a while to get that through the inflation pipeline. So we're not going to see the benefits of that until well into 2023. And wages have stabilized, but at a high level. So we do see lots of inflation elements coming down, and we are watching really closely what happens to wages, because that's going to really dictate what happens to CPI and core PCE in 2023.
Yeah, the last jobs print that we got, wages were moving to the upside. Mm-hmm. Unemployment rate actually went down. So even though we did see a little bit of cooling in that headline number, those two factors were really something that a hawkish Fed obviously would keep a very close eye on. What's your assessment just of the jobs market and how substantially we need to see maybe some of that growth begin to cool in order to get inflation under control? You're
absolutely right. It's economics 101. We have more demand for labor than we have supply. And it's really shocking, actually, to look at the numbers. When you look at the JOLTS data at over 10 million job openings, and then you look at the number of unemployed people in the U.S. at around 7.5 million, there's just a mismatch. So yes, the ultimate soft landing would be slowing demand enough that the brunt of that is felt on the opening side. So companies just freeze hiring versus actually increasing unemployment. That's a pretty tough needle to thread.
It certainly is a very tough needle to thread. Katie, I want to go back to what you said earlier when you were just talking about, you gathered some data, I know, on the cost of panicking, pulling your money out of the market in a volatile time like this. What can you tell us about that and why it's so important to stay invested through uncertain times?
I know it's so important always, but more important during volatile times. If you missed just the best 10 days out of the last 10 years, so you're talking 2,500 days, your return went down by 40%. If you missed 20 of the best days, it went down by 2/3. So there's a really high cost of missing out. And as I said before, we tend to see very strong days of the market during bear markets. And the really tough time for investors, and again, it goes back to market timing is always difficult, but it's really difficult during these times of high volatility and bear markets. The reason is the best days and the worst days tend to clump together. So you're never going to get it right because you're going to have a terrible day followed by a great day. So the best advice, the best guidance for investors, especially during times like this, is stay the course, stick with your strategy, make sure that your equity risk, that your risk assets are aligned to your longer term goals so you don't have to worry about shorter term volatility, but you really need to stick to your strategy or you'll risk missing out.
So you don't want to try to time the market, you don't want to panic and pull your money out. You mentioned strategy there. Where are you seeing the most opportunity today?
So it's really interesting because I do think it's an opportunity right now for investors to rethink fixed income. We've been talking about the bear market in equities, but my goodness, we have had a steep reset in interest rates and a bear market in bonds. And right now, fixed income is actually paying income. So investors who had been forced to take risk in prior periods because there was no return can really think more, I think, deeply about their risk tolerance. And fixed income might be a good place to be right now. We're seeing 4% type yields in muni bonds. So you are seeing some pretty nice current returns out of fixed income. So that's a place I would say would be a great place for investors to reconsider. Those who have been sort of bearish on bonds because the rates were so low. Well, now we seem to have much better rates. The last thing I would say on that, though, is from an equity perspective, we still do see the best opportunities in U.S. equities, just the best visibility, the best transparency around what's going on. And we do see areas outside the U.S. as having some exogenous headwinds specifically related to energy that are just really hard to price into markets right here.
When it comes to the growth versus value debate here in the U.S., obviously growth has underperformed. Is now the time to put money to work in some of those undervalued names?
You know, we always preach diversification. And I will say that with an economy that's slowing and interest rates probably stabilizing, it's not a bad opportunity for growth stocks because in an environment where growth is dear, investors will pay more for growth. So we would say stick to a diversified strategy. You really want to have both because trying to time those factors is very, very difficult.
Katie Nixon, always great to speak with you. Thanks so much for taking the time to stop by the studio. All right, let's get a market check with Julie Hyman. Hey, Julie.
Hi, Seana. Thank you so much. Well, we are seeing stocks show some real strength here once again today. The S&P 500 right now up 2.7%, around the highs of the session. If you look at the 5-day chart, you can see the big swings, of course, that we have been having here and the volatility that continues in this market. But really, it does feel like a more risk-on day today. For example, we've got yields moving lower below 4% here. We've got the dollar moving lower as well, which has tended to help stocks as of late. So that's something else that I'm watching. Take a look at some of the other elements here. Banks is something else that we're watching in today's session for a couple reasons. Bank of America, of course, was out with numbers that beat estimates, saw record net interest income, and that's as we have seen the Federal Reserve raise rates. Net income overall was down but beat estimates, but net interest income up 24%, and the shares are up 5% today. We also got news on Goldman Sachs, which, according to Bloomberg and the Wall Street Journal, is doing some restructuring, including continued sort of wind downs of its consumer banking business. Those shares up 2.5%. Just quickly here, if we look at the sectors, you see the strength and the broad strength that we're seeing within stocks, say, with all of the groups up, consumer discretionary, real estate, tech leading the pack, but really you're seeing a broad-based gain here. And then NASDAQ also seeing broad-based gains, almost all green. One more mover that I wanted to point out to you because it's the top trending ticker on the Yahoo Finance platform. And that is shares of, and I'll just wait for it to come up, Roblox. Roblox shares up 21% today. And that's after the video gaming platform came out with its daily active users for September, coming in at 57.8 million, and the company is now forecasting for September bookings of $212 to $219 million. This is the biggest one-day jump that we've seen for shares of Roblox going on since May, and again, sort of reflective of this risk-on sentiment that we are seeing come back into the market. It's a marked contrast with what we've seen from low blocks this year, with the shares down some 58%. So benefiting from risk coming back in. Broadly today, in terms of commentary, we're hearing about the gains that we're seeing. Most are still calling it a sort of bear market bounce here, but Mike Wilson at Morgan Stanley says we could see maybe another climb up in the S&P 500 from here, even as high as 4150. He's still a bear over the longer term, but is looking perhaps for this bounce to continue for a little bit. Much more All Market Summit and Yahoo Finance coming your way next.
Straight ahead, the evolution of e-commerce, how Walmart's Suresh Kumar plans to move forward into the great digital transformation.
The landscape of modern wealth is complex. Challenges and opportunities intersect. That's why we created the Northern Trust Institute, using advanced analytics and the best financial expertise of our firm to develop advice that's tested and tailored. We help you navigate tax policy, the art world, impact investing, real estate properties, cryptocurrency, and beyond. Where there's a trend, we're ahead of it. Where there's a gap, we bridge it. Where there's your moment, we help you grab it.